The recent spike in fear index or VIX index has only happened a handful of times in the US history. Are we out of the woods yet? According to Cathie Wood, in a video released on ARK Invest YouTube channel a day ago, this is the fourth largest VIX reading in the past 40 to 50 years. It's the fourth after 08-09 recession, 2000 dot-com bubble, and 1987. And she believes that the market is in a cathartic moment and something is changing. Right? So based on what she said in that video, she does sound a little bit concerned.
Now, what does this mean, this volatility alert? It usually means the market is meeting a cathartic moment or is in a cathartic moment. And it usually means something is changing.
I kind of disagree when she said we're the fourth largest VIX value because I think she missed the COVID pandemic recession, because during the COVID, the VIX actually spiked a lot higher than this, right? So it was spiked to 85 on March 18th of 2020. So this time, right, about a couple trading days ago, this one should be the fifth largest one. So on the day of the spike, August 5th, S&P 500 was down about 8.5% from the peak of the stock market. So this is due to, I think, multiple factors. For example, there's disappointment in the recent earnings reports of the AI companies, right? The AI earnings, and a lot of the AI companies they were giving disappointing outlooks. There was also disappointment in the unemployment rate released on non-farm payroll on the Friday ahead of the market decline, which triggered the SOM rule. Okay, and there was an unexpected rate hike by the Japanese central bank, which forced carry traders to urgently sell multiple holdings of their assets, and including stock market and also treasury bonds. And there was also news about Warren Buffett cutting its Apple holdings in half. Right? Apple is Berkshire Hathaway's largest stock holding. That shows the market that maybe Warren Buffett is seeing some problem with the current market, which caused a lot of fear. Tom Lee also talked about this in the recent interview. Let's take a quick look.
The thing that we're watching is the VIX spike to 60 on Monday, which is the third highest reading ever, and the VIX futures curve inverted, which was the steepest inversion since the pre-pandemic times. Both are starting to normalize. I think the VIX, as it closes below 20, and it hasn't closed yet, and as that VIX futures term structure uninverts, that tells us the worst of the panic is behind us. I don't think it means we won't have ripple effects, because we know there's some trapped bulls, and there's still some nervousness around Iran and how much of this yen carry trade has to unwind, but I think the worst of the selling pressure is behind us.
Tom Lee believes that the spike in the VIX was the third largest VIX spike ever. Tom Lee mentioned many times about term structure of the VIX being the most inverted since pre-pandemic. And he also mentioned that the VIX is now under 20 and the term structure of the VIX futures is no longer inverted, meaning that the worst of the panic is behind us. So for the viewers who's not familiar with the phrase term structure is the price of VIX futures contracts across different expiration dates, right? So this picture is the VIX term structure on August 5th, the day of the huge decline. As you can see on the horizontal axis, you can see August expiration, September, October, right? The further to the right, the further out the expiration date is for the futures. And they're graphed to each of the expiration date for the futures value on the date of August 5th. Okay, and on this date, as we can see, right, the term structure is inverted. And this is not normal. Again, this is the date when the VIX index spiked to 66. In a normal market condition, the term structure should be upward sloping, should look like this, right? It should not look like this. This is inverted because while the longer term future like this expiring next year May should be higher value, should be in a higher value than this one, August 24th. That's expiring in a couple of weeks, because the more further out you are into the future in a natural environment, the more uncertainty there should be. All right, but in an inverted term structure like this you're seeing right now, the futures traders are seeing some problem. They're anticipating a near-term turbulence, or a stock market near-term turmoil. Right, so this sort of shape is abnormal. And this chart is the term structure of the VIX futures on August 9th. So pretty much today's term structure. Okay, and as we can see, it's getting back to the pretty normal upsloping shape, way better than the inverted, at least for the further one, right? The value is way higher than the latest one, the September expiration futures, and this is what Tom Lee meant by the worst has already passed, right? So this indicates that the immediate concerns are easing for the futures trader, and they're indicating a reduction in immediate turmoil. And for August 5th, during the extreme volatility, one thing to be noted is actually the gap between the VIX index and the 1 month VIX future. In this chart is called VIX August futures, right? That's the futures expiring in the month of August. So the black line in the chart, the black line indicates the VIX index, and the red line indicates the VIX August futures. The concept that needs to be understood is that there is a difference between VIX index and VIX futures. The VIX index is a measure of market expectation of the volatility over the next 30 days. The number is derived from S&P 500 index options, okay? And there's a complex formulas calculating that number from the index options. The VIX futures, or the August futures, on the other hand, represent futures traders betting on what the VIX index is going to be on the date of expiration, which is in the third week of August. Okay, so that's the difference. And if we look at the date where the turmoil happened, August 5th, so during one point, there was a gap of 30 points between the VIX index and the VIX futures, short-term futures expiring in August. The spike of the VIX index is actually caused by the big spread between the bid and ask price of the S&P 500 call options, because the way it uses that is calculating VIX is actually by using the median price between the bid and ask. And during that day, there was a lot of buying of the call options, making the ask price pushed very high, right? And causing a big gap between the bid and ask. So it does show that there is a high level of panic for sure during that day. However, the VIX futures did not follow the VIX index to rise to a similar level, suggesting that the futures traders do not believe the concern reflected by the VIX index is going to last. According to some folks at Wall Street, the gap between the two, right, the index and the futures, is very important, because during the pandemic recession, which is a real and short recession, the two things surged together in lockstep. And that's how you know that's a real fear. Okay, and that's all I want to share with you today. Please answer this following question in the comment section below. I want to know your opinion. Do you think that the VIX is just a short-term reaction? The spike of the VIX is a short-term reaction, or are we actually headed for a more turbulent future? Please let me know in the comment section below, and please don't forget to like and subscribe. See you next time. Bye.